Hello Mark, and thanks very much for talking to us on Blue Notes. You've just released a new report on the Australia's gas industry when markets collide. The top line looks quite positive. It looks like the global demand for gas and hence for prices is quite positive.
Look, it is. I think this is another step in the link into the Asian market. I mean, it's the energy story, which I think is sort of lagging somewhat the industrial-based story we saw in iron ore and steel. But the length and upside in the energy demand story in emerging Asia is going to be particularly positive. I think this is one of the key, drivers why we've released this report.
Because supply is increasing, obviously. There's Australian projects coming online and there's other projects around the world, but demand is sufficient that it's in excess of that new supply that's coming on.
Yeah, there's always that, mismatch between the supply and demand, particularly when you're talking about very large volumes in the case of LNG. But it's the long-term strong demand outlook for, cleaner energy, and in this case, a baseload energy and gas, which makes it quite appealing.
That's quite a silver lining for Australia as an economy. There's a downside, though. From the report, it looks like while that's good in an offshore sense for the Australian market, not so good for the Australian retail consumer, and particularly not for certain manufacturing sectors in Australia.
You're right. I mean, what we've sort of detailing in the report is that there's a bit of a readjustment in the energy mix here in Australia, in the way of pricing it anyway. And I think what the market needs to appreciate in particularly gas, it's a very captive-based market and not necessarily priced on global metrics. So we've had an energy market here very much based around the demand in Australia. And what we're going to see in the next decade is that pricing being much more anchored to the regional and global demand story for energy.
And which particular sectors, I take it it's the energy intensive sectors that use a lot of gas that will be most impacted by this?
Yeah, it's the ones that would use not just gas for energy, but also as an input or feedstock ingredient. So the chemical industries, the heavy manufacturers, the steel and non-ferrous metal industries is where we've highlighted the biggest impact from an industry point of view.
And in the report you talk about how the price rises that are probable in this market are going to be greater in that sort of wholesale area than in the retail area. Why is that?
Well, it's because when you get the gas down to the retail level, there's other effectively large fixed costs embedded into the price. And those fixed costs aren't going to move. So it's really the feedstock or the power price itself, which is about 1/3 of the total retail cost, which is being affected by this demand dynamic.
To put you on the spot a bit here, when you look out, this is obviously a huge global market that's growing. Do you have a sense of its scale in proportion to what we saw with the iron ore and coal booms preceding it?
It looks very similar, Andrew. I think when we looked at the iron ore market, a huge positive with China being net short that commodity and for its steel demand. And gas is a very similar dynamic. They're very net short gas, they're very long coal at the moment. And the demand dynamic is really led by the ability for them to receive that gas, and which is something we'll see over the next decade, is then turning on these very large regasification plants which will allow them to receive LNG.
Well, look, thanks again very much for your time, Mark. Good luck with the report.
Thank you very much for your time, Andrew.